Okay, we're just getting ready to do personal finance, chapter 9, static problems. So if you will join me, we'll get these worked out. This is about housing decisions. Okay, and I think I have shared my screen. Yes. Housing decisions. So we've got, once again, rental costs versus buying costs. Buying costs are always going to be more, there are more things to it. There are more tax advantages to buying a house. All right, so let me put in my particulars here. I don't know if they've held steady or not. I think so. $7,380 are the payments of rental for a whole year. 145 is the policy premium for rental insurance. That rental insurance insures your personal stuff usually. And then a security deposit. These kinds of comparisons tend to want to see an opportunity cost when it comes to a deposit or a down payment. So let's just go through the rental part here. We've got 7,380, 145 for the premium of the insurance for the year. Now, I am going to put an offset of that deposit coming back. Now, these costs also depend on if you stay for more than a year or not. If you don't stay, if you stay for just 1 year, then this would work. But if you stay beyond a year, then the purchasing becomes more valuable. Come on, you're all right, no problem. I'm going back over chapter 5, and we're starting with the first problems. I heard about your, I'm, okay, anyway.
At the stop.
There's a crash?
Yeah, stop like a semi hit a car.
A semi hit a cop?
Really? Yeah.
The semis are not supposed to be going through town unless they're delivering.
I bet you he's in big trouble.
You hit a cop, you're in big
The
trouble.
back of the.
Anyway, okay, that's enough. I guess I forgot I'm recording. Okay, that's all right. Hey, we got to give them some entertainment. Okay, 5% is our interest, 24% is our marginal tax rate, and that is used to calculate the opportunity cost of that $615 deposit. What you do is you take the 615 times 5% times 1. So they missed out on $30.75 of interest income. So the total cost for rental is $7,555.75. And I think that's fine. It's the buying one that tends to be incorrect if I remember right. Okay, so let me. Now we'll go through what the buying was here. I wanted to check my work, make sure that I've got that in there correctly. I think so. Yeah. All right. So okay. So the purchase, if you add up all the mortgage payments together, mortgages are usually paid by the month. So they're talking about $10,800 in mortgage payments. Now they do have that little notation off to the side of $10,375 is interest. So mortgage payments have both, and I'll put this to the side for a note, mortgage payments have both principal and interest when you pay them. So mortgage payments equal principal and interest. And when you're first paying your mortgage, you pay a lot more of your payment on interest than you do on the principal. Mortgage payments equal interest, principal plus interest. So just keep that in mind. And that's why they're saying how much of, so gosh, the difference for how much, the difference between these two numbers, which is the $10,800, the difference between it should be 425. This is where I've got this highlighted. Okay, so when we get down there, I'll explain it again. So one more time, $10,800. We've got 10,000 or $1,050 for our insurance premium. We've got property tax of 1940. We've got our down payment of 5,500, but just like the deposit, we are assuming that's going to come back to us. When it comes to this equity payment, growth in equity, they put 255 down, but it should be 425. Okay, it should be 425, and here's why. Because up here under the mortgage payments, the $10,800 minus the 10,375, that's what your equity is. Okay, so I'm going to put this up here, see if I can explain this a little bit better. So this is equity. This is your growth in equity. So as you pay down on your mortgage, as you pay down the principal, then you get equity. Okay. So I put that beside there to help understand. They've put in 255 and that's incorrect. But we're going to make it correct to make it agree with it. Okay. My value of the property is going up $1,800. And then if you were to sell that piece of property, you would get back your deposit of $5,500 or the down payment of $5,500. The opportunity cost of your down payment and your closing costs is kind of like the rental deposit. Okay, let me move this over. There it is. So we're missing 275. That's a cost. So you have to also remember that all positive numbers are costs, housing costs. I'm going to put positive numbers are costs and negative numbers. Positive numbers are costs. Negative numbers are it's not really income, it's offset. Negative numbers offset the costs, or money paid back. Okay, so money paid back. All right, so anyway, long story short, this is all the costs for the first year. There's that equity, growth and equity that they put, but it's not correct. It should be 425. There's the value of the property going up in 1 year. There is the refund of the down payment. There's the cost, the opportunity cost of that $5,500 at 5% for a year. And then finally, this is the last benefit. This is the tax benefit. Federal income tax benefit. You take your interest, your mortgage interest, right? $10,375 is the mortgage interest plus your property tax amount, and you take it times their marginal income tax rate, which is 24%. Okay, so there's quite a few pieces to this piece or to the purchasing option. And I think all they're working on is which one is less expensive. Okay, which one is less expensive? You might not have $5,500 for a down payment, or maybe you want to save up more than that. Okay, so let's go ahead and put this in. Here's the final tally. 9,000, if I can get it in here, $9,054.40. Okay, return to question. Yes, thank you. Okay, 9,054.40. So based on cost criteria, going with whichever one is the least cost, renting is your option. Okay, renting is the option. But like I said, if you were going to stay in this house for a while, pretty soon you would benefit more from buying. Okay, Okay, some locations require that renters be paid interest on their deposit. I told you that a landlord requires a deposit so that if something bad happens to the property, welcome. That there's money there to help recoup the cost if you damage something. So if we were in a state that required landlords to pay interest on the deposit, if you had an $1,800 deposit, you would actually earn 4%. So you would earn $72 in interest on that deposit. So let me put that here. Interest income on deposit, but that would be up to the landlord to put it in an account that was going to sit there. Okay, so it would be up to them to put it somewhere that earned some interest. Okay, very good. Number 3. Okay, number 3. We are working on a condominium, usually requires a monthly fee for various services at $255. How much would a homeowner pay over 8-year period for living in this housing facility? So maybe if you buy a condo, some of these are called homeowners associations sometimes do the same thing. They mow your grass, they do this and that to take care of your place so you don't have to worry about it so much. But when you get something that's by the month, to annualize it, that you take it times 12, annualize. Okay, and then that means $3,060 annually. And then they wanted to know how much over 8 years. So 8 years times the 3,060 is 24,480. Okay, so just kind of keep in mind how much is going in there. So you might not think that adds up to too much, but if they were basically taking care of your yard for that much money a year, maybe you'd rather live somewhere that you take care of it yourself. Okay, I don't know. So, all right, number 4. Now I want to make sure we went back through this because this was a little bit tricky. Okay, this is coming up with what's called an affordable monthly mortgage payment. So once you reach that amount, then you can figure out what kind of a mortgage, how much of a mortgage you'll shop for, and then how much of a home price you'll shop for. Okay, so we take that monthly gross income, okay, $3,050. There's going to be a 15% down payment on the house. So that means we're going to need a loan that's 85%. Okay, so I'm going to put that right here next to this. So need loan that is 85% of purchase price. That's why they're telling you that. Okay, that's why they're telling you how much they're putting down, because they don't tell us. We're the ones that are going to have to figure out a mortgage payment. Okay, then it has us. So I just put everything down here. $205 is how much we have for other debt as a monthly payment. We have an estimate of property tax and insurance of $220. We found an auto or a home loan for 7%, and it's a 30-year mortgage. Okay, so the first one, and we're going to use these exhibits here. Okay, this is the first one we're going to use. And okay, you say, how do you know to use this one? The only difference is the fact that we have other debt payments. Okay, so if you see the difference between these two, if you go through here and see that other, okay, so see how this one has 380 subtraction and this has nothing. So this one you have other debt. Example A, other debt. Okay, and that's what I'll put here. So example A has other debt for the month, other debt payment for month. So that's why we're using 38%, 38%. And this is gross. This is not the amount you bring home. This is the amount of your earnings, okay? So if you take 38% of the gross amount, it's $1,159, okay? And then we're going to subtract the other debt, which is the 205, and then also subtract the monthly property tax. That gets us down to $734. That's the first answer. $734 is the amount of an affordable mortgage payment based on the information we were given. Okay, based on the information we were given. So we're going to take that now and use the other table. Okay, I'm going to check my work to make sure it's all still good. Okay, now we're going to use that other table. Okay, that other table, this exhibit 9-9. We have to remember the length of our mortgage. It's a 30-year at 7%. So this is kind of like using that time value of money table, kind of. So we have a factor of 6.65. Okay. So we're going to take our affordable monthly mortgage payment, divide by this factor here of 6.65, then take it times 1,000. Okay. So $734 divided by 665 times 1,000 is an affordable mortgage of $110,375.94. Let me put that back in. Okay, $110,375.94. And since that's the mortgage, so that's 85% of the purchase price. So then you would take that amount and divide it by 0.85 because you are putting 15% down. Okay, when you divide by 0.85, you're saying how much you're basically saying how much is the affordable purchase price, which the purchase price is going to be more because you're going to take 15% out. Right? And so the math has to work both ways. So the purchase price is $129,854.05. Okay, so let's just work this backwards now. Okay, we're going to work it backwards just so that you understand what we found. So once again, we can go look for a house that has about a purchase price, let's just say of $130,000. Then we'll take 85% of that because we're going to, I guess we're planning for a 15% down payment. So 85% of that price is about $110,376. And then that mortgage over 30 years at a 7% rate is about a payment of $734 a month. So once again, we found the payment per the month. Then we found the mortgage amount, and then we found the purchase price. And that might seem backwards, but based on the tables that we had to use, it isn't. Okay, so let me go ahead and put this in. I think we're almost caught up here. Okay, that's all in. All right, number 5. Okay, so now we're going to use those same tables. Okay, same tables, but they don't tell you that in this problem. So I'm going to scoot it over here. And I tried using the calculator, which is fine. We can use the calculator. And so let me go get my calculator that I forgot to get. We can use the time value of money, or we're going to use that mortgage factor table, not the time value of money table. Okay, so I want to make sure that you're aware of that. Let me go get this calculator. Whew. Okay. So we have a house that has, these are the mortgage payments for each of the following situations. This is a mortgage of $140,000, 15 years at 5%. So I put $140,000 in the calculator. We want the future value to be 0. We have a 5% interest. Now, the payments is what really has to change. 15 years of payments times 12 is 180 payments, and you've got to change that compounding to monthly, okay, not annually. So once again, here's our mortgage. Okay, we're trying to find our payment. Future value is 0, 5%. Periods are 180 payments monthly. Okay, so the payment is $1,107.11. Now we're going to use that table from the one we just did. So let me go get that table here just a second. I don't think we need that one. We need the other table. Yeah, exhibit 9-9. There it is. Okay, so once again, now we're going to use that mortgage factor table. So this is going to be a 15-year mortgage at 5%. That is 7.91. We take the mortgage, divide it by 1,000, and take it times 7.91. And look, we get a very close. Are these close? It's off just a few cents, right? Everybody see that? This one takes a little more. This is not the time value of money table. You take your loan, divide by 1,000, go find that factor of 15 years at 5%, and then the result of this times this is this payment, and we checked it with the calculator. Okay, so I think either one of those will work. But I'm gonna put in from the calculator and see if it's working. Okay, I gotta go to the next one. All right, see if it's working. So that first one, the mortgage payment, I'm gonna put in from the calculator and see if they accept it. Okay, I kind of got you off track on this one. Okay, looks like they did. All right, so now let's do the next mortgage. The next mortgage is $186,000. It is 30 years at 6.5%. So we're going to put that in the calculator, just like we did this one, $186,000 mortgage. Remember, we're trying to find the payment a month. We have 6.5% interest. We have 360 payments because it's 30 years times 12, and we want it on monthly. The payment is $1,175.65. Now we're going to use that table. Okay, we take the loan, which is $186,000, divide it by 1,000, then we find that factor of 30 years at 6.5%, which is 6.32. And when you do the math right here, 186,000 divided by 1,000 times 6.32, you get a very close payment of $1,175.52. So I'm going to put it in from the calculator. Okay, so we've got 117565. Okay, and then this last one is a $205,000 loan at 5.5% for 20 years. All right, so I'm going to put that in the calculator. 205,000. We're trying to find the payment. 6.5, 5.5 is this one. And now this one is a 20-year mortgage, which you don't hear about as much. You hear about 15 and 30 quite a bit, but there's others out there. There might even be others besides that too. So 240 payments, that's 20 years times 12. Okay, so I got 14, 10, 17 from the calculator. And then if you take the table, 205,000 divided by 1,000, and then the factor of 20 years at 5.5 is 6.88. And we get $1,410.40. So let me see. Yep. So those are very close. So either one should work, whichever one you're the most comfortable putting in. Okay, but our calculator works good. Uh-oh, hold on. It didn't like that one from me. 1,410.40. Okay, let me see. Okay, let me make sure I've got. Let me see here, just a second. All right, 205,000 is the mortgage. We've got 20 years at 5.5. Okay, now let me see if. Yep. Okay. Let me put the one in from the calculator. 14, 10, 17. Maybe I didn't push a button right. Let's see what this one says. Now that's funny. It took the one from the calculator, but it didn't take the one from the table. Let me go look at this table one more time. 20 at 5.5 should be 6.88. Let me double check I got 205,000 divided by 1,000 times 6.88. So 1410.40. I'm going to put that in one more time because if that isn't correct, I want to let them know. Because you should be able to get your answer from either source. 1410.40. Maybe I put something in wrong. Nope. Isn't that interesting? Okay, so this one needs to be sent in too. Good grief. Okay. You should be able to use the table they provide. So I'll highlight that and need sent in. Incorrect. Not grading right. Okay, so put in the 14, 10, 17 that we did from the calculator. Okay, so what have we learned from doing all this mortgage stuff, right? Hopefully we've learned that the longer that the mortgage is, the lower your payment will be. Yep. But if your mortgage rate goes up, or if you have an adjustable rate mortgage, anytime interest rates go up, if you don't have a fixed mortgage, your mortgage payment can go up. Okay. That's why most of the time, if interest rates are fairly low, it's good to get a fixed mortgage. Then that way, if interest rates do go up, you're protected. Okay. You've got to put in 14, 10, 17 to get that monthly mortgage payment of C to work. Okay. If any of you need help with that, let me know. So sorry about that. Okay, 6. 6 takes 2 different mortgages, right? And the first one is mortgage A, pay $970 a month for 30 years. The other one is mortgage B. Mortgage B allows for a monthly payment of $760 a month for the first 5 years. And then the last 25 years, it jumps to $1,005. So we're going to add up what these, so you take this times 30, and then this takes 2 calculations, 760 times, and then you got to do it times, you got to analyze it, and then times a year. So here's where I'm at. Mortgage A, 30 years, 970 times 12 times 30, okay? So you got to take that 970 times 12, or you got to take the 12 times 30. Doesn't matter to me. It all comes out the same. So that's 349,200 if you were to add up all those mortgage payments. I'm going to change something here. Just a second. I'm going to use that 970 by itself because we've been taking that, and I'm going to put 30 years times, I'm going to put the 30 years times 12 together. So that's actually 360. So it actually becomes 360 payments. I'll put 30 years 360 payments. There we go. Okay. And they didn't ask for the totals. They just want to know which one is the higher total payment. Okay, so then if we do mortgage B, okay, let me change that one as well. The first is paying $760 a month. Okay, you would do that for 5 years. Okay, so then we have 5 times 12, which would be 60. So times 12 times 5, which is 60 months. There's 60 of the months. Or 60 payments. And then when it jumps up after the 6th year, this jumps up to $1,005. Okay, let's take, so this last payment that you make times is 25 years times 12. Okay. 25 years times 12, and then, so you need to know how many payments that is. So 25 times 12 is 300 payments. Okay, get that off to the side so you know. So it's the same number of payments, but you're actually paying less with mortgage B. Okay, mortgage B, when it's all said and done, mortgage B is lower by about $5,000. Because this one's 343,000 and this is 349,000. So mortgage B is actually the better deal as far as the total payments that you make. Wait, what? Which would result in higher total payments. My fault. It's A. A is the higher total payments. Okay, let me put that in here. I thought they wanted the one with the lower. Let me insert this and we'll put higher total payments, higher total payments right there. Okay. Onward we go. Okay, we are ready for number 7. If an adjustable rate mortgage, you say, what's that? What's an adjustable rate? Well, just as the title suggests, the rate of your mortgage, the interest that you'll pay could go up if the market goes up. So sometimes that is a good option if the interest rates are pretty high and you expect your interest rates to maybe come back down, because just like it adjusts up, it will also adjust down, I think, if it says so in the contract. So if an adjustable rate mortgage that's 30 years for $160,000 loan starts at 5%, but then it goes up to 6.5%, which is a 1.5% increase, what's the amount of the monthly payment increase? All right, so we're going to use that table that we were using. So here's our mortgage, 120,000 divided by 1,000. Then we're going to use, there's the result of 120,000 divided by 1,000 is $120. And then from the table, 30 years at 4%, 4.77, the mortgage payment should be $572.40 a month. Okay, you need to know what that is. Then we need to figure the mortgage payment based on the new, all right, so we're looking at, let's just go ahead and, let me put this in. 5% is our original mortgage, and let me go get that table. I think I still have it open, because I think I have to go look up all right, so let me go get 30 years at 5%. It's 5.37. Yes, 5.37 from the table. 5.37. And then we want, Okay, 5.37. Okay, that should be 644.40. All right, and then the other has jumped to 6.5. And then I've got to go get that from the table. 30 years at 6.5. Let's go get that. So 30 years at 6.5 is 6.32 from the table. And then the new mortgage payment will be, with the interest going up, 758.40. So we have two mortgage payments. We were making one for 644.40, but the interest rates jumped and our adjustable rate mortgage jumped along with the interest rate that the Fed sets. So now the increase, what's the extra you'll be paying with a 1.5 interest increase? Okay.
Mortgage different.
Huh?
The mortgage is different. It's 16, not 12.
Okay, you're right. Let me get all of the stuff in here that's different. Okay, so woo, that's too much. Let's try this again. Okay, so. Okay. Yep, all right, let's try this. So 159.20 with a mortgage of 160,000 at 5% for 30 years. We divided the mortgage by 1,000, then we went to the table of 30 years at 5% and we got 5.37. So 30 years at 5%, 5.37. Then we take the payment times 5.37 and we get a mortgage payment of $859.20 a month. Then the other, once our interest rate jumps to 6.5%, then we need another factor from the table. So it is 6.32. So we take $160,000 mortgage divided by 1,000 is $160. 160 times 6.32 is a mortgage payment of $1,011.20. So the difference should be $152. Okay, so just 1.5% going up causes you to have to pay an extra $152 a month. Are you with me? Yeah. Woo. All right. We use that table quite a bit. I mean, double check my answer is right. Okay. So you got to know what the two mortgage payments are once the interest rate changed in order to find the difference. Okay. Next one, let's talk about refinancing. So when interest was really low back at COVID, people were either buying houses or refinancing their loans if they had higher interest rate. Okay, but it's got to be worth it. Okay, it's got to be worth it. So anytime you refinance anything, you have to say, well, how long are we going to live here? So let's see if I can get all the information in right. Okay, Kelly and DeAndre Brown plan to refinance their mortgage to obtain a lower interest rate. The Browns will reduce their mortgage payments by $83 a month. But they will have to pay closing costs of $1,670 in order to refinance. So the cost of the refinance, $1,670, they're saving $83 a month. They got to recapture that back before they can really start to see some savings, right? So if you take that 1,670 and divide by the amount of the savings, that's about 20.12 months before they'll actually recuperate their costs. Okay, so if they're not planning on living there for almost 2 more years, it wouldn't make any sense. Okay, it wouldn't make any sense to do that. So the recovery time, and they want it in the nearest whole number, is 20 months. 20 months. 20 months after they've had the refinance. The 21st month, they'll get their first $83 of savings that's going to benefit them. Okay. anything you buy first to save yourself money, you really need to recapture that back, however long it takes, before you really start figuring out how much you're able to save. Okay, I hope that makes some sense. Hopefully so. All right. In an attempt to save funds for a down payment, Carmela plans to save $3,400 a year for the next 5 years with an interest rate of 5%. What amount will Carmela have available for a down payment after the 5 years? So this is the future value, right? She plans to put $3,400 away a year for the next 5 years. And she's putting it in an account that pays 5%. All right, so let's put this into the calculator. We're looking for the future value of an annuity, okay, of an annuity. All right, so future value of an annuity means the present value will have 0. We're making payments of $3,400 a year into the fund. It's 5%. We're looking at 5 years. Be sure to change this to annually. Be sure to change it to annually. So if, okay, now let me double check that I've got, it was 5%. Okay. 5%. I got $18,787.15. Okay, and then I'm going to check it with the table. Now, this is the time value of money table. So I'm going to go pull that up out of my time value of money table. And we're going to look at the table for future value of an annuity. Okay, so that's table B. I'm going to put table B here. All right, let me check it here. So 5% in 5 years is 5.526. 5.526. Okay, so that's very close. So I think either one would work. Okay, 18,787.15. That's how much she will have to as a down payment on a house. Yep, as a down payment on a house. So most people want to try to save 20% to put down on, and then you could figure out how much of a loan you could get, right? That kind of thing. How much of a house to go look for price wise. All right, number 10. If you're going to buy a condominium, okay, so let me get all my numbers in here correctly. So Ben and Zane Manchester plan to buy a condominium. They will obtain $180,000 mortgage for 30 years at 6%. Let me get my figures in. We're going to divide 180,000 divided by 1,000, which will give you $180. We're going to go look at a factor of 30 years at 6%. And that should be right here. Okay, 30 years at 6% is 6. Okay, times 6. 6.00. Okay, so looks like we've got a mortgage payment of $1,080 a month. Okay, so we got to start with that. Okay, start with that. That's not what they want, though. They want the total monthly housing payment. Okay, their annual property taxes are expected to be $1,800. I have those off to the side here. Property tax is $1,800. Property insurance for the premium for the year is $480. So when you combine those two together, and you combine those two amounts together, you get $2,280 annually. And then if we want to figure that out by the month, that's $190 a month. Okay, $190 a month is how much they're figuring for their property tax and their insurance of the house. That's usually in escrow Usually that's included in your mortgage payment. And then the last one is a condo association fee, which is $220 a month, condo fee. So we've got three things to find. The affordable mortgage payment a month, then we need to find the monthly amount of the property tax and the insurance added together, and then the condo fee. And if you add those up, I get $1,490 a month is what the total monthly housing payment is, total. Okay, that's not counting, that's the mortgage, but it's beyond mortgage. It's also the condo fee they have to pay, and then how much they have to pay a month for property tax and insurance. Last question. Okay, if you estimate that you can save $3,800 by selling your home yourself rather than using a real estate agent, what would be the future value of that amount if you invested it for 5 years at 6%? So this is one amount of $3,800. Okay, so we're going to use table A. We're looking for the future value of $3,800 that we're saving at 6%. Okay, so that is different. And we're looking at it over a period of 5 years. 3,800 future value of $1 of 6% for 5 years. And I need to go find the factor. Okay, so the factor from the table. Okay, and this is one amount. So future value of one amount for 6% for 5 years. It is 1.338. 1.338. Right now, I'm going to go run this through the calculator, see if we get what we expect. So $3,800 is how much we're saving by not using a real estate person. Okay, you save some commission, but you also might miss out on some things too. So it's not always the perfect answer. Future value, $5,085.26. So that is very close to what the table says. Okay, so either one of those should work. 5,084.40. I'm going to put that one in. Okay, that should end us with chapter 9's work. Okay, so I am going to stop the recording now, I think. Yep.